Welcome to another episode of Catalyzing Radical Systemic Change, where it's all about discovering, mapping, and cross-pollinating what I think are the necessary building blocks towards a planetary civilization ahead. And today, the broad topic will be Web3. And when I look on the outsides, like the main news media outlets and FTX crashing, then obviously, my first question to you, Jahed, would be why Web3 at all? I mean, you're an investor, you're building up a fund, you're an expert in the space. So I would like to, maybe it really educates best the listener when you sketch your own biography and let them know what got you actually interested in Web3 and why, despite the boom crashing, you actually think it's more important than ever to focus on Web3 and really look where Web3 makes a difference, especially for the great challenges where we have out there facing as humanity. So having said that, just link your biography to the topic, Jahed.
Man, well, hey, Alistair, thanks for having me. I'm usually on the other side of this, right, as a fellow podcaster. So it's nice to be on the other side of the table and not have the pressure of the interview guide. And is it going to go well? And can they hear us and all that? So this is great. I love just showing up. And do we cuss on this podcast, by the way? Is that allowed? Okay. Just got to check sometimes. It's good to come on here and bullshit, right? Like, I'm really looking forward to this. Like we have these wide-ranging conversations in person. So good to reconnect and really dig into some stuff for the next 80 minutes. So my biography, why Web3? It's funny you asked that too. That's like I say with probably all of the companies and entrepreneurs I've seen in this space, it's at or near the top of the questions I ask when I actually meet them, right? So I'm like, okay, this seems like a decent, thing. Why Web3? Why put it on a blockchain, right? And there has to be a really good reason because these technologies have been around for about, 14 years now, just about, and they have some decent use cases. They have some features that make them useful for particular markets and outcomes, right? And so that kind of gets into why I'm even interested in this. So as you mentioned, I am an investor. I started a fund called Cerulean Ventures, where we are basically investing in the overlap of open source software and climate and environmental tech. So basically, we see, for me, you and I think, really vibed on this when we first met. I see a lot of the crises that we're dealing with now. Some people call it the meta crisis, right? A lot of the crises we're dealing with, I see as basically crises of ownership and agency, basically. And so for me, that's what really caught my imagination with these technologies, is that they open up a really wide design space around how assets are owned and governed, and not just assets, but almost anything, right? So if you can make a form of value capture, value sharing, value exchange legible, it can be then transacted upon, and a lot of other primitives and ways of interacting with it can be brought to being. And so these ways of capturing and sharing value in new organizations really caught my attention. The other thing, which seems to be, as an investor, really caught my attention is, when I'm sure we're going to get into this, but if you're born into a relatively westernized society, I say westernized because the way that we organize socioeconomically isn't just in the West, it's pervaded every nation state, right? The nation state itself really is like a European creation in a lot of ways. We have a lack of institutional diversity, right, in a lot of what we're doing. And so this is the second thing that I'm really interested in, is how do we bootstrap new forms of institutions? And how do we create institutional diversity such that our only choices are not a public domain governed by nation states and the representatives we have, and the private domain, firms of varying sizes who privatize things and honestly pretty much rely on ecosystem services and a bunch of the commons for their ability to do anything, right? So that's kind of what caught my attention. And getting into my biography, I got into the space because, my imagination was caught up in these things. And I've been in the space for about 6 years. I kind of got into it originally with the early protocols. Aragon and Gnosis really caught my attention in the way they were thinking about new forms of organization, right? So they were very into self-managing organizations. They were thinking about what does decentralization mean beyond just the technology, right? So like, what does a self-managing organization look like now that there are smart contracts, right? I thought this is a really interesting idea. But I never didn't really put my 2 feet into it that deeply until about 2020. And before that, I was an entrepreneur. I founded a company called Magalix through an incubator in the US, 500 startups. We sold that company in 2021. And I've been in the tech space for about 12 years before that, just as a product person working on some things I'd rather forget I ever worked on, ad tech, and healthcare in the US, which I think is, I don't want to divert too much, but just to say that digital health and healthcare technology in the US really is butting up against the political and social problem and hoping for a technological solution that will, make it cheap, affordable, and all this. And I'm just like, no, this is you're barking up the wrong tree. This, and so for me, I had gone through the experience of being an entrepreneur. I had also, kept a really close eye on this, and I also had a background in platform cooperatives, right? So for me, it was really interesting to see what's possible with network effects and just getting communities to organize around particular outcomes when they have huge upside in them, right? And if I kind of recount the things I was saying around, distributed governance and then institutional diversity, this is kind of like the third pillar where I got to see like, whoa, the Silicon Valley people talk about network effects, but even seeing what happens when you give your communities upside and the economic value they create, like, do they have any idea? Right? Like they're talking about Facebook and Uber and Airbnb's network effects, but what about when you actually say, hey, you there who are a part of this value network, you get a piece of this, and when you contribute to the protocol or to the company, you ride along with it, right? So it's like a really interesting concept. And so these experiences were that cooperative, by the way, was Savvy Cooperative. I'm still an advisor to them. I love them. They're doing great work. They basically are a patient-owned cooperative for research insights, and their customers are all the top 20 pharma. You name them, they're the customer. Basically, all the biggest pharma companies in the world who really realize that they can no longer just rent customer insights from market research firms. They must include patients wholly in the process, and Savvy Cooperative is the biggest voice there. So out of those learnings, right, from Savvy, from self-managing organizations, from some of my personal political history, kind of came together when I came into this climate problem. And then finally, like last year or a year before that, met Regen Network, who kind of helped me synthesize this fund with my partner, Matthew Stotts, around this idea of how do we build new institutions to scale climate impact. So that's kind of a little circuitous route to answer your question. That's how I got here.
I feel like before we dive onto the fund side and the investment side, which I really think we will share a good chunk of the conversation, I feel like there's still a part of me wanting to educate the audience, which I usually don't do, but you were mentioning agency, ownership, and institutional diversity, as well as that from your platform cooperative perspective, obviously you would need to ask why all the network effects that are kicking in, building multi-billion-dollar enterprises, but ultimately having an extractive business models where you have very few shareholders, and actually the people creating the value are basically, they're completely disenfranchised, right? So this does not sum up into one question, but maybe give some sparkles of hope and inspirations that took you on that path to starting that fund.
Oh, absolutely. So I think let's dig into it. I already talked about them a little bit, but let's dig into it a bit more, right? So like, let's talk a little bit about my experience in platform cooperatives. So the one in particular that I have a lot of experience with, I mentioned Savvy Cooperative. I don't know if I'm allowed to name their revenue numbers, but let's just say that in the last 5 years, they've gone from 0 to a healthy 8 figures in pretty amazing time frame. And this is a sustainable business that's not burning a ton of venture capital. It raised revenue-based financing and equity from exactly one venture capitalist, and that was in DVC. They do basically they give you more friendly terms than just seed and equity funding and kind of fucking off in the classic VC sense. They actually structure things such that they can take equity and arrange a debt instrument. And this was really key to their growth, right? Because they didn't have to then sit there and go, how do we ever 100x this to make it worth Bryce's while, right? Like they actually could knock him off the cap table by paying back 3x of the investment and getting 90% of his equity off the table, right? And that gives them immense flexibility. And this is important because this is really what got me into this, because I looked at Savvy as a business and said, how do we make more of these, right? Because let me just walk through it really, right? I didn't think I'd be talking about this today, but I love talking about them. So this is great. So Savvy is founded by Jen Hoare and Jeff and by Ronnie Sharp. They're both patients. So Ronnie is has cystic fibrosis, and Jen was a juvenile arthritis patient, continues to be an arthritis patient. She's not like arthritis affects everybody. It's not just for older folks, right? She's my age, and they had a pretty keen insight about 7 years ago when they were matching patients with studies, right? They're both chronic patients. They're part of patient user groups and these patient groups that basically advise hospitals, right, in the US on like, hey, what is literally the user experience of using your hospital? How could the patient care be improved? These kinds of kind of listening groups and all that, right? So they realized that the pharma people who would come to them for these studies and be like, hey, do you know a patient who is is 60 and has diabetes and maybe has an Android phone, like we're doing a digital intervention, this, that, and the other. They realized that like these people don't really have direct connections with patients. All they needed to do was just ask patients before they do something. And that has become their like motto, hashtag ask patients, right? That's all you got to do, right? And so that's one of the key powers of this, right? And then around that time, they had met a fellow, I believe he had met Nathan Schneider, who's big in the cooperative movement. He's a friend of ours as well. And Nathan, had been putting together a platform cooperative manifesto around that time. I think it was 2015, 2014, something like that. And Jen and Ronnie were like, hey, this makes a lot of sense. If we're going to have patients actually be the ones who provide insights, they should have upside in those insights, right? And they shouldn't be like one-time insights. They should be, captured in a way where the patients would own the data. So we were going to start, if you think of the end goal of like, I delivered an insight to a pharma company and they used it and paid me somehow. Working backwards from that, if you're a patient, you're like, well, what are they going to do with that? Who owns it? Like, where does, and all that, right? So they started by negotiating what's the most equitable thing for patients. And they have, like, now when you think about it, this is radically different because if you've ever dealt with some of these folks ever, and if you've been a patient, the way it works is they go, hey, here's 50 to 500 bucks for your time, sign away your rights to everything and fuck off, basically, right? And what their keen insight here was that actually you don't want a one-off relationship here. You want to build especially in like rare or orphan diseases, rare diseases, chronic conditions. You need to understand this disease as it unfolds in time. You need to understand the relationships involved. You need to get a full picture of the person if you're going to design an intervention. So what better way than to have a place where you can find that person again? They don't just disappear into the Craigslist ether, and you can have constant interaction with them throughout their entire life cycle, gather insights, really build and test products, and make sure that the upside is maintained for the patients. So what ends up happening is that in the cooperative model, from the revenue that's brought in, a sliver of that revenue is folded back into the co-op, and it is a revenue share that's paid to all the member owners, right? So this is all kind of, the rest of it I can't really get into too much because it's also privy to governance and some things are trade secrets, what have you. But basically your participation in the co-op, whether you bring another person in, whether you do a research study, you do a lot of them, maybe you're very active in the co-op, then translates to your dividend, right? And so you could be sitting there doing like 3 studies and sure you're paid like $200 to $500 for them, but at the end of the year the co-op does well, you're going to get a sliver of the revenue, right? And if we're talking an 8-figure business here, 15 or 20% of that might be a dividend that gets folded back in the co-op for all the member owners, and that's a substantial amount of money, right? And all you had to do was participate and grow the co-op, and your actions are, are tracked with your opt-in, of course. And this model, like when you look at the Facebook patient groups, the Twitter talk about, chronic diseases, it took off. Like the patient growth is insane, right? Like just sorry, it's a little ableist for me to say I should have picked them, but this is really surprising, right? You're like, and you have these people who maintain Rolodexes of patients and what have you, but I had never seen anything like it. Like you're talking about double-digit growth in patients per month with secular not doing anything, right? And very quickly you're talking about tens of thousands, hundreds of thousands of patients, members of the not members of the co-op, just in the community, right? Um, and so this was to me was like, oh, dude, these guys are not doing. They don't have like a ton of marketing. They're not doing performance marketing. They're doing anything. This is just patients realizing that if you give a shit about their data, if you negotiate for them, with them and for them in goodwill, and you make them a part of the community by giving them upside, not just saying they're a part of the community, this is powerful, right? So for me, this was like, I got to pay attention to this. How do you do this, right? And so for me, coming back out of this a little bit, the co-op model I'm still struggling with, because I think capitalizing co-ops is a really open question, right? Like starting them, bootstrapping them, funding them, they don't fit into the venture model. And I'm beginning to think that they shouldn't, and that's okay, right? Like we need to find other ways to get them going, because they're 100-year projects. They're not 10-year projects,
I get the pivotal moment and also your zest to templatize your learning that feeds into the fund. For me, and I reckon also the listener, now the question is, what does everything you have mentioned about Savvy have to do with Web3 and blockchain / distributed ledger technology? Why does this make a difference?
Yeah, really good question. So at a first clip, right, I would tell you that a lot of my dabbling and dithering and study in this space so far is really still around the nascent hypothesis of, can we scale co-ops with these new participatory technologies, both on the two sides, one on the sharing of economic upside and the other on the sharing of governance, right? Because I'll tell you, DAOs in the Web3 space, decentralized autonomous organizations, are also feeling this is a really big, a kind of an annoyance to me at this point. I'm sure everyone who's heard me on other podcasts with this is like, God, get over it already. We get it. What DAOs can learn from co-ops and what co-ops can learn from DAOs is, in a way, really just the entire fund for me, right? Like, it's basically these keen insights that were just smashed in my face with the daily interaction with this co-op and seeing its growth. I was like, great, okay, but 51% of the cap table by law in a cooperative is owned by the member owners, which means it's really difficult to capitalize the business. If you think of a perspective of like investing at Series A, Series B, Series C, if you look at the most successful companies, and not even that, just not even most successful, just companies that don't die, right? Who are like post Series C and are maybe going to be on an IPO path or acquired, their cap tables, their capitalization is pretty straightforward. There's anywhere between 10 to 25% dilution of the shares in every round, which is new investment, right? And that comes from somewhere. And when you have 51% of the cap table set aside for member owners, legally you cannot touch it, right? It can't be diluted. Then that severely limits, you're basically playing with half of the cap table, right? As a business. And so it's no wonder that as venture took off as an asset class with Fairchild Semiconductor, I think it was the 60s or 50s, whenever it was, I don't remember, that you had, you're playing with 100% of it, right? And so like there in some ways, we are selecting for, in the design space of institutions, we're selecting for the ones who can, and I'm sure you have something to say about this, you have a little bit more flexibility on the cap table, but you also have this, you may have noticed this too, and listeners may have noticed this too, there's this, in Silicon Valley especially, there's this sort of like, there's an air around founders, right? Like founders are the ones who make these things happen, right? It's that they're allotted the group of 1 to 5 or 4 people who can And what's clear is that there's a very complex ecology of any growing business, a market, and decisions that have to be made. And when there's three people in the room, you can theoretically make them faster. But you look at the co-op model, and that's what I was talking about, DAOs and co-ops. Co-ops have learned you don't have to vote on everything, right? Like they've learned this because they've been around for more than 100 years, since the Rochdale principles approach in the early 1800s. DAOs are sitting here going, let's vote on every fucking thing in the universe. And it is, I'm answering your question in a circuitous manner, but basically, why Web3? I think that there are, and I still believe that there are, and I see that there are abilities for crowd contributors, people who want to work on a thing together to process the information in this complex ecology I mentioned, right? Where you have, you're sitting here going, like, here's a new thing we want to do. Maybe no one has done it before, or we're going to do it in a new way. It's a startup. But we're going to integrate more perspectives. There's going to be more than just the founders. There's going to be more people working on this thing. There's going to be more of the pie to share with them because we have a token cap table in it. We might have a token as well. We might be able to reward people intrinsically and extrinsically, but in the ways that we design this organization. And this is the part where it gets hypothetical, right? We're like, can we get people to play with the whole cap table? Can we get people to also share the upside from that in a way that we get the best of both worlds, right? That's really that's what enables you, what's kind of what this design space of in new institutions enables you to do. I hope so, right? That's kind of the bet, right? Is to say, hey, can we share more of the upside? Can we play with the whole cap table? Can everyone win?
Let's go with this, can everyone win? Because again, when we look at the example you have just mentioned, I think it's a very obvious example, right? Usually the patients basically get a one-off, close to nothing, need to sign a contract to hand over kind of all their data forever. And it's not really, not even efficient in the sense of for the pharmaceutical producers, right? Because they don't get longitudinal data, nor does it incentivize, especially for rare diseases, on the patient side, to stay in contact with those that might procure solutions for these rare diseases. I think that's a good example. Since those that have listened to more podcasts here, I really think one of the big challenges we face is to tackle the challenges we have through the power of entrepreneurship, but creating business models that both within the DNA of the purpose of the organization truly give back to nature, rebuild soil health, mitigate climate change, get the plastic out of the oceans, but at the same time, and you have mentioned a lot about that, is to really create business models that also incentivize and create a flywheel for those who are actually really contributing. So I wonder how you create the segue from that like long example of Savvy into the fund you're creating. So kind of what are your underlying perspectives, premises from which you're starting that fund?
Absolutely. Great question. Because I think it also really brings us back to nature and the opportunity for the fund, right? Like why didn't we just start a shared ownership fund that invests in co-ops or that invests in crop-like entities and doesn't really give a shit about nature? Why is nature on the front page, right? Why is climate on the front page? Going back a little bit, I mentioned the word agency. I really see the climate problem and the meta crisis as really a problem of agency and incentivize, and a step further than that, full accounting and incentivization, right? And this is the other piece of the blockchain piece when you asked me that I forgot to mention, and it's funny, it's just been a long day, but what I think is really interesting, this is certain features of blockchains and DLTs, right, is that they address the double spending problem, they make data traceable with provenance, and they make it, obviously we'll come on the show and be like, whatever a database can do that. SAP can do me provenance. And it's like, can they though? Right? Like, go ask them, right? I can tell you right now, there are some companies in our portfolio who work with the biggest commodity producers in the world who are basically saying, who can go to them and say, hey, I know you think you have provenance of that cacao that you just delivered into the Swiss, into the EU economic area. Just let us run the data for you. We just want to check it, and we'll check it against our data, and you'll see that, someone like Cargill or Mondelez or what have you will have 50 to 80% of the data in their supply chain will be completely wrong, right? Because it's just single entry.
Interesting point.
Yeah.
I think the way that I understand the unintended consequences of distributed ledger technology, and you just cited the example of provenance, is actually, sweethearts, now we really have the possibility for radical transparency. Now we can really trace, we can really double check your data, because so far, I mean, Mondelez is the best example, right? Like fig leafing ESG measures, especially for cacao, and being able to showcase data that does not uphold the scrutiny from a third entity. Yes. I mean, that's very core, let's stay just with the cacao industry. So I'm curious how you tie that into your fund structure, because I really think we are in a pivotal moment, despite the second crypto crash, where a lot of the positive ripple effects of distributed ledger technology will really ask for radical transparency. And I'm not so sure how easy the big players in the market that are fig leafing most of their ESG measures, that's at least in my language, right? It won't be that easy anymore to just fig leaf it, right?
Yeah, absolutely. And it's funny because I don't think that, and I want to absolve the blockchains of any responsibility for this. When it happens, it's not going to be because of them. In the EU specifically, at least, it's going to be because of regulation, right? So like, it's going to be because the EU will say, if you can't make a claim about this, give us 4% of your revenues, right? Like it's straight up. It's not about hey, once in a while come and check it and you need to be able to prove it. No, it's you need to make a claim about it, and you need to show verification of that claim. And if you don't have the data, that's a 4% of revenue fine. It's very stiff, right? So now getting back to, the fund structure, right? So for me, the way I think about this is, and I think this really dovetails into some of your views, is that, you mentioned about human thriving, soil health, all these other things. When we talk about the system that the economy is within, right? Neoclassical economics and then the neoliberal turn will basically, there's a couple papers out there on this. Costanza, 2018 or so, I think, is the one that comes to mind. People have tried to compute what is the economic contribution to the economy from ecosystem services, right? What we call ecosystem services every year. The number is anywhere from 16 to $54 trillion. And there's a lot of interesting thoughts happening in the venture space around this as well, around tokenizing natural assets so that they can be made legible and their contribution to the economy can be priced, right? Now, I actually think that is really important, but I also think how it is done is also just as importantly as that is for whom and how, right? Because I can imagine some really dystopian scenarios where we tokenize things and we just run along with the public-private divide that we have for property, and it can get really bad, right? Like it just reifies the existing structures, right? So for me as a fund structure, I think about this in this way. This number I threw out is quite large, 16 to $54 trillion. You'll see 33 trillion. Sometimes people almost go, but let's pick the middle of it, right? But that's every year, right? That's what we get. That's what the economy is able to output because clean air, clean watersheds, fisheries, CO2, topsoils, everything is kind of just, magically provided for us. It's not magic, of course, but now for us as a fund, we think, well, we actually need to value these things, right? Because the only way that we can see value today is we look at a forest, for instance, and we think, well, I can cut this down And I can see value in two ways. I can graze it, or I can sell the timber, or I can do both, right? But think back a little bit to what I said about ecosystem services. And I want us as a fund to give you a really clear example. I want to be able to go to a family office that has most family offices have timber or land holdings, right? And a somewhat common thing that you'll see in U.S. family offices is there'll be a new tract in the Carolinas of new trees planted uh, 18 years ago today, right? A particular type, and those trees will be harvested at about the 18-year mark because they're paying for a generation of college, right? And so I would like now the times are changing, as you know, too, right? In the impact space and in the family office space, people are coming, the children who are now like coming over and taking those over are doing it in the middle of a climate crisis, and they're thinking to their parents and grandparents are thinking, well, you know, I would like them to understand that their land holdings can be valued in a different way, right? Those trees can have trustful, high integrity carbon credits issued that represent how much carbon they sequester per year. There can be soil health metrics and credits issued as well. If you have the technology to measure that, in some respects, we do in a lot of places. There are people working on this problem. And that enables us to then say, hey, this tract of land where previously we could, burn it for swidden farming, or we can, cut it down for timber, can now be valued in a different way. A revenue stream can be realized from it by not doing it, by not extracting from it, right? By actually stewarding it, right? And now you may even say, what if we were to take regenerative agriculture methods and actually do the next 10 years as restoring the topsoil? What does that do for the ecological and diversity of that area? And is there a way to price that where it's not just an offset, right? That's a really key thing for us, is that we don't really like to think about offsets so much, because I don't think the time for offsets is past, in my opinion. We need to really be thinking deeply about how do we heal and not just go, well, how do I do a little bit there and fix a little bit here, right? So that's just to come around to answer your question, right? These are trillion-dollar markets. You, in my opinion, you do not need massive ownership stakes that really return funds to all the same people. And you don't, even if you're working with the right values aligned entrepreneurs who have their eye in the right place, you may not even need board seats. Right. So that's kind of like, that's where our views are right now on this.
I think throughout the conversation, I feel like I want to repeat sometimes the question. So I get the ecosystem services. I'm ditching the ontological question whether we're opening just another Pandora's box to giving a price tag to everything, including ecosystem services, because
it's a real concern.
It's a real concern, because
yes.
How do we do it, and whom does it serve, given the underlying, let's say, power imbalances in the world? But let's assume this opens a Pandora's box that creates business models that ultimately enable regenerative business models. And for that, you need underlying architecture, scaffolding, conceptual frameworks. And then the question is, why is Web3 technology, so Web3 technology / DLT / distributed ledger technology, crucial to that? Especially to the example you cited. Let's stay just with the timber forest. I think we can really spend just 5 minutes on the timber forest for somebody who has never been in the space. Why would that really unlock a new generation of regenerative business models? And what is needed for that? And then obviously, how do you structure your portfolio of investments to enable the infrastructure and the scaffolding to make that happen?
That's great. And a great compound question. So make sure you're doing a great job of this, of coming back and making me remember the other part of it, because I might miss a part of it. So very good. So I think this is a great example, the timber one. Let's dig into it, right? So what does it take to build an economy out of this, right? When you think about it, and why would Web3 have a part in playing in building this economy, right? So I actually think the timing couldn't be better for this conversation. If you follow any of the controversy around the voluntary carbon markets in the mainstream, right? So there's a number of pieces which we can dig up and put in the show notes, of course, but there's the Guardian piece, and there was a piece in Decite, which basically looked at Vera carbon credits and was covering a particular scientific publication that was looking at how these credits were issued and whether they actually stood up to the claim of sequestering the carbon that they were supposed to, right? Now, I think this is it's good to divert a little bit and talk about the stakeholders in the voluntary carbon market to help you understand, why Web3, right? Why would you need to bring a DLT into this? So, but I'm going to paper over some details here, and people can come after me for it. It's fine. I actually 2 weeks ago did a podcast of my own with a nature-based solutions expert forestry scientist. So I'm happy to refer you all to that if you're like, oh, well, you missed this detail. But anyway, so I am a landowner, right? I'm not a carbon project developer, but I'm a landowner who owns, 10,000 hectares, or maybe even, let's say, 1,000 hectares, right? You really can't do much more than that. So what you do is you want to do a carbon project. You want another revenue stream for this. You're lucky enough that you have enough land to do it. Great. Now you contact one of the major, there are project developers throughout the world. There's Alcott, South Pole, there's a number of them. You get into their pipeline. Then you get so these are now you landowner, project developers who work on the carbon projects, bring them to market. They bring carbon supply to people who want to buy it, right? Now, in the various intermediaries, which there are many, the next one that's germane to this is Vera. These are the registries, right? Vera is one of them, Gold Standard, American Carbon Registry. Vera and Gold Standard between them have 71% of the market, 91% of the market. Now, what happens at this juncture is there are also other providers. There's a couple of other people in this milieu, folks like Patrama, who provide digital MRB, among other services, monitoring, reporting, and verification technologies, right? So let's say I'm the landowner. I contract with a project developer to develop a project. The project developer goes, okay, this is going to take about 100K in startup costs or what have you, because we have to survey the land, we have to make measurements, we have to build to Vera standards to basically say, here's what it will actually sequester over the next 5, 10, 20 years. And that takes a lot of people with a lot of very specific expertise. Now, now let's say you go through all of that, the project is verified, it begins, you start it, you plant the trees, you begin to sequester the carbon. Vera or the registry, whatever registry you go with, comes and measures it once a year. Now, let's stop there, right? Now, I said a couple of things like, well, let's do it once a year. Let's build some PDFs. Let's take some, measurements here and there and have some humans sign off on them here. But where in this process have I really dug into what's happening in that forest, right? There isn't, the trauma I mentioned, there's digital MRB, but there's a lot of human actors and some might say even bureaucracies involved in this, where at the end of the day, they have certain incentives and they're going to make certain decisions that are in front of them, right? You could explain the voluntary market with zero bad actors and just incentives for the most part, honestly, right? So where does a blockchain and other technologies come into play? One of the things we are very interested in is looking at, say, that same tractive forest and saying, what if you were constantly monitoring it with Landsat, so basically satellite imaging, LiDAR, and honestly, this is the latest stuff that's come out in the last 10 years and is very solid in proving, and it's been tested in proving out measurement of carbon sequestration, right? It's just that this technology hasn't filtered out to the players in the marketplaces, right? Now, on our side, if we have LiDAR, if we have Landsat moving tree cover, if we have people on the ground coming in a constant fashion with relationships with the people who are actually doing this, verifying the polygons, this is work that's actually happened, right? This happens all the time. Then that gives us a really clear, rich picture of what's happening, and it's a constantly updated one. And for some of these tasks, we can actually just assign them to autonomous monitoring in these forests, this has been tested, it's been done. We can actually then query that data and say, hey, what is the reading in that forest for tree diameter for the sampling of trees that we have? Are they growing in the way they are? Honestly, we don't even need to get that specific. For the Vera controversy, it was really just more about, are the trees still there? Right. So like, right. So being able to say either via a oracle, oracle is simply, you could think of it as, you're making a call to a database to say, hey, I need to know in this database, in this column that represents whether the tree is here or not, what is the reading, right? And the reading would just return, I'm here or I'm not. And you could do that through an Internet of Things device, basically, right? Or you could do it through tree cover, through Landsat, whatever you want, however you want to design it, right? This is one of the promises of this technology, is that you could say, you can remove some of the trusted assumptions, right? This technology started by looking at the trusted assumptions necessary to provide, double entry bookkeeping for the ledgers of bank accounts, right? This is what Satoshi and the Bitcoin folks and the cypherpunks were really talking about. But you'll see, and this is what's really keen for me, you will see this problem once you see it once. You will see it everywhere in society, right? You will look like, wait a second, but if my trust relies on the banker doing that thing, what about, the forestry scientists? What about the project developers? What about the energy?
I want to riff off that, and
Yeah.
where we get it juicy, it feels like almost like we're at the deepest inflection point of the conversation. I think for everyone who got inspired by that famous or infamous white paper, and leaving aside all the problems of, let's say, Bitcoin, right? Because this is not a Bitcoin conversation. I really think disintermediating,
there it is,
and disentangling the trust that we need to have in people that are seemingly verifying stuff that we actually don't have any bloody fucking idea of, I mean, when I need to share just an example, because I'm a macroeconomic nerd, mainly really a macroeconomic nerd. Just the last days, the Bank of International Settlements disclosed the biggest default of international credit swaps ever. It's more than the total sum of the combined GDP of all nations. So no, really, just the last days.
Oh my God.
Yeah, exactly. So this is, I think, a very good example where we are with double bookkeeping since 400 years and late stage capitalism, where we trust the big banks that are too big to fail. So that was just riffing off in my personal commentary.
Yeah.
From structuring your fund, and maybe give one other example so that people do not only have the timber forest example. What is your investment hypothesis?
Yeah.
How do you structure your deal flow? What are the typology of people that are interested and really see that and sense that inflection point where we're right now there, that we had now centuries of, I'm just bullshitting you, but I'm a big bank and I'm too big to fail. Or I'm a big brand. I tell you it's green cacao, but I don't change anything in my supply chain. It's still child labor, but you're happy with your milk car, kind of talking about Mondelez. I really have the feeling a lot of the adversaries of blockchain technology are those who have most skin in the old game, right? These are the ones who are saying, yeah, it's just crypto woo-woo. No. It's really actually a technology that enables trust building in a radically decentralized fashion, instead of needing an expert 10 levels up who earns 2,500 times more than yourself just to tell you something that you actually know yourself, right? Just the usual thing. You sign a contract, you need to go to a dude you will never see again, pay a chunk of money and give a stamp on a piece of paper that he reads out loud to you, right? I mean, that's the promise of distributed ledger technology, right?
Yeah, absolutely.
Anyhow,
And I think,
how do we get that? How do we get that inflection point to the construction, like, and the, let's say,
yeah,
scaffolding of your fund?
yeah, absolutely. And I think it's like it's almost like a theory of change, to be honest, right? Because I think um, when you're doing, especially when you're in venture, I think that these I wouldn't even call it necessarily a hypothesis, more of your thesis, right? Like, what do you think is going to happen, right? What shape is it going to take? And for me, what I really look for, and how, how do I make this happen? I think that I just turn back to maximizing uh, human agency, right, in a lot of these systems. And I think that when you look at, what is the tree carbon example? I'm not going to go back into it, but really what's most interesting to me about it is that right now on this earth, something like 70 to 80% of the biodiversity is stewarded by indigenous people who get $0 for it, right? Zero, they get nothing, right? And so one of the things that they're thinking about here as a fund is saying, how do you extend agency to folks like that on their terms, such that their economic contributions are priced on their terms and they're actually can realize something from that, right? And what does that require? It actually unfolds into an investment thesis, right? You need to know who they are in a privacy preserving way. You need to know what organizations and institutions they can form and help, and they give them the tools to form those in a privacy preserving way, right? And so what does this look like as an investment thesis? We look at a lot of things, just in those two, groups I just mentioned there. We look at how people can safely transact and exchange value with each other um, in these systems. And specifically, that means things like, how can we bring data on chain, climate data, financial data, and safely? How can we bring institutional liquidity and capital into the space in a way where I don't have to teach them how to download a browser extension and learn a seed phrase and all this other garbage that shouldn't exist, right? Sorry, MetaMask. Actually, I'm friends with a lot of some folks there. I'm not trying to shit on them. I'm just saying that it's a lot to say to this banker in your example to come like, well, hey, sir, I heard you also have a division that invests in alternatives and land and can preserve land. And please just walk this way and use my MetaMask wallet to do it, right? So we look at that and say, what is the infrastructure that needs to exist so that people can transact with each other in a safe way? And then next, the other thing we really look at is say, now that I have that, how do I create a valuable thing that people will actually want to pour finance into, right? And some of the things I think about here are, look, we're not just in a climate emergency, we're in a crisis of even climate finance. When you look at how much money we need to put into these things right now, the only problem is that a lot of the, going back to the institutional security and infrastructure isn't there, right? Like if I wanted to go and buy $100 million of carbon credits today, it's impossible unless I'm doing it in the EU emissions trading scheme, right? I could do it tomorrow if I wanted to do that. And but it's just not, it's not an open market, right? So we look at that and say, where it makes sense, right? We don't want to marketize everything, but where it makes sense, where can we use what we've learned for market primitives to create new markets in these assets, right? And so this basically involves looking at, I told you today, Alistair, hey, you and I, we probably are going to take 10, 15 flights this year. We want to offset our climate impact, right? How can we do it in a way where we know it's going to mean something? But then also, if we're holding this carbon asset as a nature-based asset, right? Nature-based solution, if we actually want to continue financing this, and then we also think, well, actually, the future of this asset is uncertain. Is there a way for me to hedge? Is there a way for me to actually, protect against downside risk? You, me, the bank across the street, impossible to do that today, right? So I think things like this is just the nature of the world that we are. It's the baggage of the system that we've come in. When you're talking about some of these people who are just dragging, screaming into this, they're like, well, we like the way it is in the old world, right? Well, this is the unfortunate truth of that, is that risk capital wants a return, right? It doesn't matter if it's venture, it doesn't matter what it is, right? A bank is going to want 6% in the money market or whatever, right? So we think that a key thing that we need to figure out is how do we build the liquidity and the assets necessary for someone to, like UBS, to come in and say, okay, we actually trust this asset now. We want to hold a bunch of it. We also want to hedge. We also want to be able to say, and not just hedge for speculation's sake, we must claim the underlying asset as a retirement of the impact we have in the world, right? So that we're not just out here moving the ones and zeros from one column to another, right? So that's a really key part of our investment thesis, where we look and say, hey, who's building new functional market primitives that can make the holding of these assets, the hedging of these assets, derivatives, perpetuals, things like this, meaningful to institutions so that they can get off their asses and put the trillions that we need in finance into the space, right? Because if people hear this, go, oh shit, speculation on climate assets, you're like, well, actually, in some ways, I think that's good if the design space is correct, right? And so one of the things that I'm thinking about here, and one of our investments actually does this, is we do want traders, commodities traders, to be participating in these systems. And then we want to make sure that the system that was built around them to enable their transactions, just a sliver of every transaction, imagine, goes into a project development fund, right? That sits there and says, hey, you came in here and, whatever, you moved some semi-fungible carbon A to semi-fungible carbon B, and you've hedged your position, fantastic. The transaction fee on this, today's transaction volume is $1 billion, and we were able to peel off $110,000 a day and put it into this project development fund that goes directly to people, going back to our conversation here, who are stewarding biodiversity for free, right? That's the kind of system that we see as regenerative, where we can just look, it's not just the system that we're in a lot of ways, going back to the institutional diversity point, and you can stop me if you want, I just love riffing on this shit. But you go back to the institutional diversity point, we have firms of various sizes. They have the inputs of human capital and maybe some other inputs that come from another firm. They spew out the same shit. It is shareholder returns, right? And so if you try to put on some, a different view on this, and you zoom out and you look at what's happening in the major, economic centers of the world, there's just a bunch of shit piling up, right? And you want to look at here and say, in a regenerative system, where can I take the thing that's spewing out the excrement, the waste product, and maybe plug it in somewhere else or make another input out of it, right? It's not going to be as simple as just one of them. It's a very complex system, but we're trying to peel off some of these and say, okay, NASDAQ, the S&P 500, the CME exchange, the Chicago Mercantile Exchange, pure speculation, pure hedging, economic returns only, etc. What if you did that, but said, I now have a little sidecar that's meant for regeneration, that's built on top of the climate assets that I know I need to build by 2030, and I definitely need to build by 2050.
Yeah, let's stay with the $1 trillion funding gap and try to move the $1 trillion funding gap through the super simple Horizon 1, 2, 3 scheme. So since you're a fund manager, you need to find companies that you invest into. If I understood it right, you try to build both the institutional frameworks as well as enable regenerative business models so that they are then able to absorb the quantum of capital that is actually needed. Because actually, when you were putting out that I want to buy 100 million, which I know to many listeners sounds like a big figure, right? Wow, 100 million, it's big. No, we need billions and billions and billions. So we don't need billions, we actually need trillions. So we need to build infrastructures in the regenerative space that are able to absorb the quantum of capital that is normally done only in infrastructure investments. So I'm sitting since plus 15 years, actually since almost 20 years, with this like $1 trillion questions. So coming back to your fund and the Horizon 1, 2, 3 model, imagine you're successful. What happens? What is the output of the fund in the next 3-5 years? And what would a subsequent fund look like?
Yeah, that's a great question. So I think what we've conceptualized for this first fund is that we want what we've been calling a great freshman class of the people who are kind of working in regenerative finance. And we are looking across all asset classes in climate, right? We're looking at renewable energy, we're looking at methane mitigation, we're looking at pricing methane mitigation, we're looking at really the things we can think of that are as the most impactful for climate, just from a perspective of just metrics, right? Like what's going to get us to 1.5 degrees C, it's going to keep us within that in our calculations, when others, of course, we're beyond that, but still, like, you still have to try, right? And so for us, thinking about the 3-year period, we want to be able to say that we have a great freshman class of the top climate finance, pioneers who are looking at methane mitigation, who are looking at the unlocking the spigot, right, of climate finance with derivatives, with swaps, with the things that give institutions comfort, right? Because in this next 3 years, if you even just hit a little chink in the dam there, we think that a massive amount of liquidity can enter this even in just 3 years, right? Now, if I turn back on this and say, today is February 1st, 2023, and 2026, what does success look like? It's having one of that freshman class of about 30 come out of that rubble and say, we cracked the institutional question, right? Because what I think that does is, if you think of it as an ecology, right? If you crack that amount of finance that we were just talking about, 100 million or whatever, like billion, trillion over the next couple of years, it enables a lot of downstream innovation, right? It unlocks a new ecology of forms, in our opinion, right? That's really what we want to see. And what does that look like, right? Well, and I'll give you a couple examples here. So one of our closest partners on this is Regen Network, right? So Regen Network, I'm not going to get into everything they do, but what they are is they're a eco asset origination platform, right? So they have in their governance network, they have scientists, they have landowners, they have project developers, they have indigenous land stewards, they have a bunch of people who are equally incentivized and directly incentivized. They're given governance shares in how the protocol works, and they participate in putting new methodologies through, in verifying them, in updating them, and saying, oh, this one didn't work, it issued too many credits, it issued not enough, whatever, right? And what we see is, if you can get the Regen marketplace, Regen registry, if it garners institutional trust, it opens up a direct pipeline to the wallets and the hands of people who are doing this work. And if you do that, it's like hooking up on one side institutional trust and liquidity with the decentralized movement of that. Even, I'm not even quoting Web3 people here. I'm quoting people who are at the world's biggest public-private partnership conference at COP27, World Climate Summit, right? They're sitting here talking about, how do we catalyze and coordinate a worldwide decentralized movement for regenerative agriculture, and how do we remunerate it, right? I think in 3 years' time, we're not going to do that. But I think if we have a one proof point where we can say, we cracked that nut, $100 million entered in 1 month in transaction volume for an eco asset, doesn't have to be carbon, maybe whatever the hell, right? Like carbon. People have this carbon tunnel vision right now, right? Like carbon, this, right? There's so much more to it. But I think for us as a fund, we crack the institutional nut. We already have people diligently working on how we involve people with stakeholder ownership, with who really are incentivized to think about how to properly do this with science on their side. I think that's a great proof point, right? Now, if we go on to the next horizon, right, we're talking like 72 months or what have you. I think that's what it was kind of in Horizon 3, right? Now we're talking about, like, I want to be able to say that not just in the Web3 world, but anywhere an eco asset appears, right? I'm now using the more general term eco asset, right? It could represent a biodiversity credit. It could which represents the biodiversity in an ecosystem, which honestly is TBD. All we know now is that as of COP15 in Montreal, this is now like top priority for the UN and for all the corporates who are sitting here mining, right? Saying like, oh, we're destroying the environment. We need to have a framework around this, right? So for us, in this, sort of 6-year time frame. Now we're talking about entirely new asset classes that it doesn't matter where they are anymore. There's no Web3, Web2 distinction. That stuff has gone into the background. No one is ever even using, honestly, I'd even like this if no one is even using the Web3 word anymore. It doesn't matter because it's just a database. It's either a distributed one or it's a centralized one, but it doesn't matter because they talk to each other. And we're talking about how is the value of those exchanged? How much more do we need? What new incentives do we need to build? What needs to go through governance? How do regulators interact with it? We're asking these questions, right? We're not talking about like, should we bridge it on a blockchain or not, right? We're far beyond that. The assets are real, value is being created, it's trusted, there's less fraud, and we have functioning markets. It's not happening opaquely and behind the scenes through OTC transactions, right?
A bifurcation question. I think we got some ground covered of the pivotal moment and also where you with your fund want to make a difference. Let's move beyond the fund perspective, because I know its focus is kind of the core piece on your desk to manifest it and make a difference. What is the stuff, consciously rather broad, what is the stuff in Web3 that excites you most, that sparks most of your hope? And what's the stuff that you think is rather used to fig leaf, rewrap, repackage the stuff we don't need anymore?
Good question. So I think I'm going to start with the stuff we don't need anymore. I don't want to see another centralized exchange that doesn't have a serious plan for decentralization. I don't want to see fiscal and legal arbitrage across jurisdictions just to please or not, as we have seen, regulators, right? Like this kind of chicanery is done with, right? And to some extent, people say, well, the regulators need to get their shit together. Like, yeah, sure. But the problem is like, we already know that's not going to work, right? And we need to, as a space, stop. And this, I'm speaking to other VCs here as well. We need to stop looking for exit paths that involve dumping on retail investors. That's what the last cycle was all about, right? Like a bunch of people are sitting here holding the bag. The VCs who didn't get destroyed made out just fine, right? And
let's stay with the dumping piece, because I think for those who have not been diving into the rabbit hole of why FTX and why crashing, I really think it makes sense to shed a light upon, because I mean, those who got tricked were the retail investors. Those with already big tickets, they either diverted way before or whatever,
or they just wrote it off and it's not a problem for them, right? Like you look at the amount. Let's definitely talk about this, right? You look at the amount of capital that a Sequoia is managing, right? Having to write down a $250 million investment obviously sounds like a lot of money to me and you, but we're talking about like the biggest VC managing 100 billion in assets. That's not even 1 percentage point of their AUM, right? Of their assets and their management. So for them, it's just like, yeah, well, really goofed on that one. Let's move on, right? But the people who are left holding the bag, I want to get even more granular in this because it goes beyond FTX, right? I want to talk about Sam Bankman-Fried. I mean exactly this when I talk about jurisdictional arbitrage, right? Just going like, I'm going to spin up 100 entities. There's going to be, 10 in the Bermuda here and a couple in the Cayman here and the one onshore here, and they're going to do these things here with each other. And along all of that, it's not just FTX. The man had a hand in dozens of protocols, right? And those vesting periods, this is what should really, I'll get someone into some of the technical, investor concepts here. Like when you as an investor come in and the founder tells you, so we're going to launch a token, and the vesting, which is, how much of it, like how you realize your investment and control it basically is, we're going to give you a 6-month clip, which means for 6 months, you can't do anything with it. But after 6 months, that 6 months you've held it, where you'll have a 4-year, if you're lucky, a 4-year vest. But like, and lucky, I mean, as in like responsible, right? But most people are coming up to going like, you have a 2-year vest, which means your investment will pay out. You will be able to control all of it within 2 years. So monthly, most of it, some more of it will trickle to your wallet, and you can sell it however you like. Who are you selling it to? We're going to build liquidity pools on Coinbase and Binance and FTX. So you can go there and we'll hype the project and you can dump your investment and who's buying it? Retail investors who KYC through Coinbase and FTX and all these other places, right? So, I'll pick a few examples here, right? Bankman-Fried was very big in Solana, right? So there's the Serum project, the decentralized exchange. There was Alchemix is not a Solana project, but it's one of the other ones he invested in. There's all of these. If you can go there right now, you can look at their price charts. They debut on FTX. They do a little bit of this, and you can tell the day that the vests of the investors are clear, the cliffs are clear, right? Just boom, right? Sell pressure. And who's on the other side of that? It's the normies, it's the retail investors. So it's not just even FTX. It's just that FTX was used as a platform to build liquidity for hundreds of projects that were then just dumped on people who had no idea, right? So this is the kind of thing that we have to ask of founders that we meet and entrepreneurs and say, who's holding the bag, right? Like, my vest is 3 years. Who's buying? Right? I think it's a very valid question. And we ask this, and founders will tell you, I asked them this question. Like, I'm happy to put into people are like, look, this is a great project. The impact is there. It makes a lot of sense. However, I noticed there's a token. What's your strategy for building liquidity for the token? Because you have to be thinking about that the same way you'd be thinking about a stock. And I'm not going to say everything I said there doesn't mean that all tokens are securities. That's not my jurisdiction. But the point being that eventually you're going to want liquidity for a project. And I do not want it to be coming at the cost of people who are just like, oh, this looks like a cool token. I'll buy it and hopefully it goes up. It has to come from some actual utility for all the use cases we talked about, right? From DLTs, right?
But my gut feeling is when people ask me, of my own analysis, it feels almost like the early days of the 20th century. There were, 150 car manufacturers in the US, right? And then it crashed, and then, 15 were left, and then, they got into bigger conglomerates. So I don't think it's just per se the mechanics of capitalism leading to oligopolization, separate podcast, but really just dumping stuff on retail investors that hope that they have a lucky streak, but actually not doing the due diligence actually on where they're throwing their cash at. I reckon most of this is over. And I reckon that 95 to 98% of all the tokens will be like the famous penny stocks, right? They will never recover with some hopeful examples, right?
Yeah, I think that's right.
So I think we got that FTX dumping bullshit on retail investors that don't do their homework, due diligence, or at least listen to a couple of podcasts. And I don't mean two, more like educate yourself for a couple of years. I did educate myself, for 8 years now or so, constantly on Web3, and I would still not call myself an expert, but there was a reason why I was not simply, throwing my hard-earned a fiat cash into some woo-woo coins. And I really think it's also a lucky sobering up for many people in the space that I think have not done their due diligence. And now that FTX crashed, right? Meaning some of the retail investors, amongst them also obviously friends of mine, that I think we're just believing into that magic of, well, I don't need to do anything, and I put some money there and just kind of magically self-replicates, which is anyhow like not my philosophy. So that's all of the stuff that we don't want anymore. What
Yeah.
excites you most in the space? Not only in your portfolio, what lights you up, like in your heart space or something like that?
This is going to be kind of funny, actually. And I think you're the second person I've told this. I don't think I've even told my wife this, but I am like secretly a Bitcoin maxi. And so one of the things that I'm really excited about in this next run up, I see so many applications of Bitcoin in renewable energy and in methane. And I'm imploring entrepreneurs out there, this is really exciting work because look, when we're talking about institutional diversity, we're talking about like, the garbage in, garbage out, everyone's shitting, like the firms are shitting out the same thing and no one's eating, and we have to find a way to like hook these systems up, right? I'm super excited. Like when you look at the data on methane, it's like a substantially huge part of the climate problem, right? And we will continue to, in this decade, we will continue to do new oil and gas discovery. With this is not going to stop, right? And everywhere that happens, there's going to be methane flaring, right? And currently, people just like, we talk about capitalism, we're going to pick the cheapest. What's the thing we do? We just burn it, whatever, make it carbon dioxide. It's better than CH4, move on, right? But being able to mobilize Bitcoin mining in one step and mobilize data centers in another step to actually go to these places and fully capture the methane is and make energy out of it. And I'm talking about a couple places, landfills and oil and gas wells. This is a super exciting thing. And there are a number of top-notch scientists working on this problem at Vespian Energy and in another place here in Europe, Power Blocks, that not in our portfolio, but we're very excited about them. And I see this as a really substantial impact on the climate problem. If we can scale this up, which we can, um, there's a lot of factors aligning with this and geopolitical ones as well that may or may not swing in its favor, depending on how China and Taiwan works out. But this one really excites me just because I'm in a lot of these circles, Alistair, where, we haven't even used the term refi that much, I think, on this podcast at all, which is nice. I didn't want to explain yet another term, but the refi folks really go out of their way to shit on Bitcoins. Like, we're not like that. We're over here with our proof of stake and it's 99.9% less, climate impactful, what have you. And I'm like, guys just haven't really taken the time to study this problem, right? Because it's not about the emissions. It's about the fact that we have intractable political and economic problems. And we found almost a cheat code with Bitcoin in some of these places where we can say, if we think about this the right way, if we orient ourselves around it with the right perspective, it can be the energy purchaser of last resort to make renewable energy in some of the world's poorest geos viable so that we don't build rent extractive things out of charity and just say like, oh, let's just build microgrid solar here because it's the right thing. No, we can make it economically viable. And this is what most excites me when we go back to the Saudi conversation. How do we lay down solar in the places where it makes the most sense, but where the global north has extracted and stolen wealth for generations and now turns around and says, well, we couldn't really do that solar thing in the DRC because they're not going to be able to use the money. They're not going to be able to use the power because their society is not as complex and they don't have a place to put it. Therefore, it's not going to be profitable for the PPA, for the power purchase agreement. And to that, I say bullshit because we put those people in that situation, and we have a cheat code here with Bitcoin where we could literally say, and people are doing this. This is what really excites me. What if we had, there's three things to do with energy now. One is we use it. Two, we store it. Three, we have an energy purchaser of last resort. And that energy purchaser of last resort, the ownership of that is split with the local community. And over time, faster than 20 years, the typical power purchase agreement, they own that infrastructure, right? That is what really excites me, right? And there's this couple, I've been thinking about Bitcoin a lot in this instance, and I really think there's a lot of promise there if we just orient ourselves the right way, right? This is just very near term, right? And the things that excite me a little bit longer term than that, right, are having people come, like having another perspective on marketplaces, right? And I know this sounds super boring, but stick with me on this. what do people do in software marketplaces? What do they do and what's their conception? Well, it's like, oh, let's just capture some supply. It's all this stuff on. You gotta have enough supply if the demand side is gonna buy, right? And then we're just gonna start another one, and then we'll be interoperable with the other guy, and yeah, it'll be great, right? And that's what DLTs are really getting to unlock is to really lock in the economics and the governance in the same layer, right? And so when I think about what's enabled by marketplaces in these new Web3 settings, I'm really imagining like some of those concentrating forces that were the last phase of the internet, right? Like Uber and Airbnb and all that, like you can kind of rewire those in the way that we were talking about, like community network effects. Even more so, you can pull them into the governance layer of these marketplaces. And now you don't have to have these dynamics where it's just the biggest marketplace eats everyone. You can very quickly and agilely build new ones, build new pieces, new governance frameworks on top of these. And I'm really excited to see what this enables for the agility of these new eco asset marketplaces. You might have one that specializes in a particular one because its network governance is all, West African land stewards, and they're going to build they're going to have their commodities, they're going to have the credits that right along with them, they're going to have the restoration, the regenerative ag stuff, and they're going to be hyper specialized in that. But they'll be able to exchange value with one in Brazil that's maybe not doing, it's just doing afforestation only. And I really see a chance for a huge amount of institutional diversity in the marketplace governance of these things. And I don't see them going away. They can persist as hyperstructures, right? That's kind of what I'm looking at when I look at something like Uniswap, which we can do another goddamn podcast, actually. But like, I look at that and I go, man, it's going to be amazing to see centers of economic activity with their own marketplaces that can be interoperable and governed, right? That's like a 20-year horizon, right? But like that's one thing that really excites me, through interoperability and sharing across borders like this.
I think that's for me, it feels like that's a beautiful end note, because the way that I use the Horizon 1 to 3 model is not in an orthodox way. The way I perceived you is Horizon 1, get the fund off the ground.
Yeah.
That creating the architecture, the scaffolding, and almost molding the concepts to really just enable regenerative business models that are really regenerative, and enable local communities, amongst those you mentioned, the indigenous, to really participate in the value that can be traced, monitored. Secondly, my takeaway, which is actually a really funny one, is like, how can we incentivize disenfranchised communities through the methane aspect and give them a piece of the Bitcoin cake? It's really an interesting one. And obviously what incentivizes me most, and also hence, you and me and the people we cross-pollinate in our ecosystems, is how do we really create new institutional and governance frameworks that create the diversity that we need to tackle the many challenges out there? Because I think when you were talking about, you were not using the word myopia, but I really think we have too much focus on the climate problem. I really think it's a big problem. I personally say it's also an agenda set. Because building radically decentralized new marketplaces with a multiplicity of actors and radical transparency on chain, that would be my third horizon. And I agree, not in an orthodox manner, because I reckon it will take 20 years, but I also don't think it needs to take more than 20 years.
Yeah, absolutely. And I really love that, actually, the radical transparency bit, because I think that I definitely agree with you that, and I believe you even said this on the pod already, right? Is that I think that the climate problem is a subset of a larger agency problem, right? It's a problem of institutional design. It's a problem of human agency and being able to feel our effect in the world, right? And we look at our institutions, right? And the nation state is too big to address the mutual aid problem that's around the corner from my house, and it's too small to address the climate problem. So we need something we need to begin to, I use the word bifurcate. There needs to be something that, we kind of say, this is purpose built. It's fit for this purpose, this neighborhood level, or, city to city, or what have you. And then on a larger scale, what is that actual scale of that problem? What is the type of problem you need to solve, and what is the institution fit for it, right?
Jahed, more to come. Thanks for the conversation.
Really, this was great, man. It's absolutely being, this, I feel too amped to go to sleep, but this was great.
Thanks so much, Jahed.
Thank you, Alistair.